Empirical Asset Pricing, the cross-section of stock returns, is a detailed exploration of the methods and theories used to understand the variations in stock returns based on empirical evidence. It covers statistical techniques and models, delving into how certain risks are rewarded in the equity market and how these can be measured. Here's our pick of top 10 insights from the book. 1. Traditional asset pricing models often fail to capture the complexities of real-world stock returns. The classic models, KPM, Fama French, you'd think they'd have it all figured out, right? But no, these theoretical frameworks strut down Wall Street like they own the place, only to trip over the reality of stock returns. It turns out the financial runway is far more unpredictable. One gust of economic wind, a sprinkle of market sentiment, or a dash of behavioral finance, and poof, traditional models' predictability goes out the window faster than fashion trends. So, what's an investor to do? Adapt, improvise, and brace for the catwalk's capricious whims, a reminder that the market always has the final say, and sometimes it speaks in riddles. 2. Behavioral finance factors like investor psychology play a significant role in the pricing of assets, challenging efficient market hypotheses. Picture traders as a horde of over-caffeinated meerkats, hypersensitive to news with emotions flaring. The world of empirical asset pricing is a wild safari, and the meerkat traders' psychological twists and turns steer the beastly market in unpredictable ways. It's not just cold, hard numbers and rational projections. Oh no. Our meerkat friends' mood swings, from irrational exuberance to doom and gloom pessimism, often cause asset prices to boogie like it's disco night in the savannah, much to the chagrin of the efficient market hypothesis advocates who thought everyone was doing the robot. 3. Liquidity is a multifaceted concept that impacts asset prices and is not fully understood or incorporated into existing asset pricing models. Picture liquidity as the financial world's mercurial shapeshifter, always relevant yet frequently slipping through economists' fingers like a bar of soap in the bath. It's that crucial, can I sell this thing without losing my shirt question that haunts the nightmares of stock traders. Despite its pivotal role in the asset pricing pantheon, understanding liquidity requires the finesse of a cat burglar and the insight of a sage. With models grappling to pin it down, it's about as compliant as a cat in a bath. Recognizing its multi-pronged nature is the first step in the grand dance of incorporating it into our financial crystal balls. Easier said than done, but nobody said finance was for the faint of heart, right? Keep your assets liquid and your wit drier. 4. The Fama French three-factor model expanded the understanding of stock returns beyond market risk to include size and book-to-market factors, but it's not comprehensive. The Fama French three-factor model, the financial equivalent of adding paprika to your deviled eggs. Suddenly, there's a whole new level of flavor. Broadening the taste palette from bland market risk, Eugene Fama and Kenneth French tossed in a pinch of size, small minus big, or SMB, and a dash of value, high minus low book-to-market, or HML, to sizzle up the explanation of stock returns. But here's the kicker. It's like seasoning without salt. Sure, SMB and HML added zing, but we were left craving more ingredients for a truly delectable model. Researchers realized the market's kitchen is more complex than a 3-ingredient recipe can handle. Who knew stocks could be such gourmets? 5. Anomalies in the cross-section of stock returns, such as the momentum effect, suggest that market efficiency is not always a given. Oh, the market, that moody beast. One day it's strutting down the catwalk of efficiency, and the next it's stumbling over anomalies like a supermodel on banana peels. Take the momentum effect. It's like the stock market version of the more you're hot, the more you're hot. Stocks on a winning streak tend to keep winning, much like your favorite sports team on a sugar rush. It throws the efficient market hypothesis a curveball, suggesting our oh-so-rational market sometimes follows the herd, like teens chasing the latest TikTok trend. So investors, tie your laces tight. Predicting stock returns might just be more about catching waves than calm sailing on the sea of perfect information. 6. The asset growth anomaly indicates that companies growing their assets more rapidly tend to underperform, contradicting traditional growth investment strategies. Here's a quirky twist in the investment universe. The asset growth anomaly behaves like that one rebellious teenager that refuses to follow the family tradition of growing assets leading to growing wealth. Instead, these overeager companies are out there, bulking up on assets faster than a bodybuilder on a protein binge, only to find out that their financial muscles don't necessarily impress the stock market judges. It's like the more they hit the asset gym, the less their stock price flexes in response. Investors scouting for a winning portfolio might want to take this paradoxical peculiarity into account. Sometimes less growth can mean more dough. Who knew that in the race of investments, the tortoise's approach of slow and steady growth might just outperform the harebrained asset sprinters? 7. Incorporating higher moments like skewness and kurtosis in asset pricing can provide better insights into risk assessment than volatility alone. Ever felt like volatility was the only spice in the stock return stew? Think again. Higher moments, skewness and kurtosis, are like adding a dash of paprika and a sprinkle of cayenne to your investment analysis. Skewness, our pal showing the asymmetry of returns, basically is your stock more of a lefty or a righty, and kurtosis, the peakness or flatness connoisseur of the distribution, can kick your risk assessment up several notches. They're like that duo at the party who ensure things are neither too bland nor predictably wild. Dive into these moments, and you might just find the secret sauce to an all-weather portfolio that can handle the market's moody swings. 8. The cross-section of stock returns reveals that industries play a crucial role, and industry-neutral strategies may overlook important risk factors. Picture your portfolio as a bunch of balloons, each representing different industries, bobbing on the unpredictable winds of the market. Now, conventional wisdom might have you paint all your balloons the same shade of industry-neutral gray in hopes of a smoother flight. But the colorful truth? Industry factors are like gusts of wind, uniquely buffeting each balloon. Ignoring these could mean missing out on harnessing the real drivers of return, and you might just find your carefully curated bunch tangled in the nearest tree of risk factors. So don't be industry blind. Embrace the rainbow to keep your investments soaring high and handsome. 9. Machine learning techniques are emerging as powerful tools for dissecting the cross-section of stock returns, though they pose new methodological challenges. Picture this: the stock market as a chaotic kitchen with countless ingredients that influence stock returns. Now enter machine learning, akin to a culinary robot that sifts through this pantry mayhem to find the recipe for investment success. While these snazzy algorithms whip up predictions with chef-like precision, there's a catch. They're also cooking up a storm of new puzzles. From overfitting a statistical souffle to interpreting the secret sauce of their decision-making, these high-tech tools are flashing their LED-lit warnings. Handle with care, or your financial feast might just end in a burnt bottom line. 10. The risk-return trade-off is more complex than previously thought, with various factors interplaying in ways that are not fully explained by traditional linear models. The venerable risk-return fairy tale, where we once believed that scaling the risk beanstalk would inevitably lead us to golden returns. Enter the plot twist, the financial Shrek, if you will. It turns out our hero's journey through the stock market forest isn't just about climbing higher on the risk ladder to pluck plumper profits. There's a whole cast of characters: size, value, momentum, and more, each interweaving in an intricate dance that would perplex even the most skilled ballroom dancers. Linear models strutted around like they owned the place until multi-factor models sashayed in, turning the beat around. Now we realize that the market moves like a flash mob with its own choreography, sometimes in sync, sometimes freestyling. And if you're 2 steps behind, well, let's just say you won't be crowned the king of the financial prom. So, grab your factor compass, diversify your dance styles, and maybe, just maybe, you'll groove your way to desirable returns without stepping on too many risk rakes. To sum it up, empirical asset pricing, the cross-section of stock returns, challenges traditional asset pricing models by illustrating the influential role of behavioral finance, liquidity nuances, and anomalies like momentum and asset growth. It reveals the need for more comprehensive models that include aspects such as higher moments and industry effects, and it points towards machine learning as a promising frontier for analyzing the intricate risk-return relationships in the stock market. Hope you enjoy this overview, and thanks for watching.